Are you looking to take your personal finances to the next level? Well, you're in the right place. Welcome to the Monday Money Tip Podcast, presented by I Was Broke, Now I'm Not, with your host, Joseph Sangle.
Well, welcome to another episode of the Monday Money Tip Podcast. My name is Joe Sangle. Fired up to be with you on this Monday or whatever day you chose to listen to the podcast. We're on episode number
53,
and that is the voice of my co-host, Megan Hibbard. Are you fired up about the podcast today?
I am.
Yes. So you just celebrated July 4th?
Yes.
Yes. And now we're headed into the fifth season that happens in South Carolina, known as Inferno.
I was about to say Inferno,
And so,
yeah. It's
Inferno.
really hot.
So we have first summer, Inferno, second summer. It's something I learned when I moved to South Carolina in 1998, 20 plus years ago. That's awesome. And so today we're going to talk about a very important topic. Not always the most exciting, but we're going to try our best to spice it up a little bit. And what is that topic?
Stick with us. Today we're talking about insurance. So our question is, I find the world of insurance so confusing. Maybe you do too. All of the various companies can say I can save money by switching to them. Some of them are more popular than others. Can you help us figure out how to make a wise decision when it comes to insurance providers? Also, it'd be great to know what types of insurance I need and what we don't need.
That's a great question.
Yeah.
And a lot of people feel like they're insurance poor, like they have so much money going to insurance. And so we're going to help with that today. That's going to be great.
Yeah.
Hey, listen to this, because the podcast episode on insurance, this one right here, may not be like the most exciting on the first blush side of things, but it's this topic, insurance, is where most people that we coach save the most money. So if you're interested in saving money, stick around. Today we're going to help you. But before we do that, we get to have a great, that right now relevant part of the podcast. What is it? Let's go.
Now it's time to get caught up with our current money events.
This portion of the podcast is sponsored by the I Was Broke, Now I'm Not insurance page. On this page, you can find tons of helpful information relating to your financial journey. For more information about today's current events relating to insurance, be sure to visit the Next Steps insurance page at iwbnin.com.
Yeah, and we have a great link there where you can get insurance quotes right online, and it'll help you a lot. So I encourage you to check that out. iwbnin.com. Click on Next Steps Insurance. Today, because we like to be right now relevant in the current money events section, we're going to talk about summer vacation. You fired up about that?
Yes.
Summer vacation. In fact, as this podcast releases, I'm probably on vacation. Probably.
We wait till August.
Yeah.
Yeah.
You go to the beach or the mountains?
The mountains? No, we go to the beach.
No, I don't. The beach is my bride's favorite. Jen loves the beach.
Yes.
A lot of people love the beach, but you know, I'm very pale, and I go through a cycle of burn, peel, burn, peel, burn, peel, burn, cancer. So you know, I put on SPF 7000 and retreat until the evening. I like it in the evening, except for when the shark fins start showing up for an evening meal.
Oh gosh.
And on Twitter, you can watch a shark. All these sharks, have you seen it?
No.
They have shark accounts. These big great whites, they've tagged them, and every time they come up near the surface, it pings them, and it sends a tweet about their location. And they're like 13 miles off the coast of South Carolina right now.
That's terrifying.
Like a 15-foot female great white shark.
I can't do the water anymore.
Oh, my Lord Jesus, help me.
Between sharks and jellyfish.
Yeah, there we go.
Yeah.
So today we're going to talk about summer vacations, and I want to talk about how this is right now relevant to your finances and give you some tips so that your summer vacation, while it might be inferno-ish, is that a word? Will help it be awesome. Number one, don't let your summer vacation, don't let it break your financial momentum. A lot of people go on summer vacation. I used to go on summer vacation when I was writing the I Was Broke part of my book, and it broke my financial momentum. It actually gave me momentum the opposite direction, because I would invite my bride's little three sisters down. They would fly down.
Aww.
They were so cool. They were teenagers. And we would go to the beach, and we would blow it up. We would go out to eat everywhere. We would rent the hotel.
You got to get ice cream. You got to go pay putt-putt.
Oh, yeah, all of it. And all of it
Yeah.
was paid for with A, cash, or B, a credit card.
Then a credit card.
A credit card. And did I pay it off immediately?
No.
A, or B, pay lots of interest and stress. It was part B. So that's how I wrote the I Was Broke part of my book, and I don't want that to happen to you. So don't let it break your financial momentum. And if you go into debt for a vacation, let me ask you the question, was it really a vacation?
No.
I mean, you're going to be reminded of that vacation for a long time.
Yeah.
And if you financed a $5,000 vacation, you might end up paying $10,000 for it by the time you pay all that interest.
Wow.
And so I encourage you to use our mini budget, found, of course, at iowbnin.com. It's wildly popular. Like 5 people per day visit it. It's amazing.
It is way more than that.
But you can plan your vacation costs, and it helps ensure that you don't overspend. And the cheapest, I want to remind you of this. And I don't know if this is true for you, but it's true for me. Some of the cheapest vacations I've ever taken have been just as good as the most expensive ones we've gone on. Going and parking at my family's house, and that's cheap. And going down the river in the canoe, and going and visiting the local zoo, which is super cheap, that type of stuff. Man, I've went on cruises, and I've went on some pretty nice vacations, and I've had just as much fun on either one. So they're both great. Do both, but make sure it doesn't blow up your financial momentum. You know, I spent a week in a 70-year-old cabin in the UP. You know what the UP is?
I do because I'm
They're
looking
called
at
they're
it.
called Upers. They're called Upers. Did you know that? See, listen, all my people in Michigan know what I'm talking about. The Mitten State, they know what that means. I went to the UP and I rented a 70-year-old cabin. It cost me next to nothing. The floors literally went up and down and all around, like you kind of slid down one way and up the other. It was awesome.
Was it freezing?
It was kind of cold. It was 50 every night in the middle of the summer. And that was my goal, is I wanted to leave the summer of Inferno, the season of Inferno, and drive till I found 50-degree nights. And I took my little 2-year-old boy when he was 2.
Oh.
And I wanted to have campfires every night. And I've got video of him, you know, with just diapers and a little long sleeve shirt and hitting the fire with a stick. And he loved it.
And now he's a Boy Scout.
And now he's a Boy Scout. And he's probably still hitting the fire with a stick.
Probably.
And I've spent 2 weeks traveling by plane, train, and automobile through England, France, and Italy with my new high school graduate daughter. It costs a little more than the 70-year-old cabin in the Uper. Both were awesome. Both were planned for, and both were paid for before we left. And I want to make sure the same happens for you. And so this summer, great. Vacation, awesome. Don't let it blow up your finances. And that's it for today's current money event. Get fired up.
Awesome. All right. Well, our success story today comes from Debbie. And Debbie says, we attended the FLE, so that's our financial learning experience, at New Hope in Garner last fall. I started budgeting in November, December after participating in the course. I heard it would happen, and it did last week. I forgot it was payday, and overdraft is a thing of the past. Thanks for everything, and I love the podcast.
Yes.
Well, thanks, Debbie.
So that's from North Carolina, Garner, North Carolina. That's your home state.
It's near my home.
Is
yeah.
it near your home
Garner
state
is
there?
near Raleigh. Yeah.
That's awesome. And so a couple things I love to point out is, number one, she started budgeting, and in just a couple of months, like about 5-6 months, she was able to achieve something like forgetting payday. Does it mean payday's not important? Absolutely not. But we say this many times in our events, that you can tell you're starting to win with money when you forget that it was payday, which means you're not dependent on every dollar as soon as it shows up, which is great. And overdraft is a thing of the past. And I'll tell you, if you're listening to this podcast and overdraft is part of your life right now, you just need to knock it off today. And you can do that by doing budgeting, doing what Debbie said. And man, we celebrate with you, Debbie. Thanks so much for taking the time to write in your success story. We just celebrate. As I say all the time, this podcast is sponsored by Success Stories. It's the fuel that powers us. Way to go.
All right. So today we're going to dive into our teaching on insurance. So to remind you of our question, here it is I find the world of insurance so confusing. All the various companies say I can save money by switching to them. Can you help us figure out how to make a wise decision when it comes to insurance providers? Also, it would be great to know what types of insurance I need and what I don't need.
That's a great question.
Are you ready?
That's a great question. And so you're going to help with this podcast today.
Yes.
Are you fired up about it?
Yes.
Yeah. So there are 5 types of insurance that pretty much every person in America, Canada, and most fully developed nations need.
Yes.
Okay. So let's go through those.
Yep.
So list the first one.
All right. So the first one is home or renter's insurance.
Yeah. So if you own a home, you must have home insurance. Even if you paid it off, it usually costs about 0.5% of the value of the home per year. And it's a transfer. That's what insurance is. You're transferring risk to someone else. And that's a good buy. If you're renting, many people don't understand, especially when they're starting out life, that their stuff is not insured by the owner of that home or apartment.
Right. Just the dwelling.
Just the dwelling. And so you need to have renter's insurance, which covers the value of your possessions. It's usually like $15 to $20 a month. It's fantastic. Get it. Tell everybody about the second type of insurance they need.
All right. The second type is automobile insurance.
Okay, so unless you don't own a car, which many people in a megaplex like New York City may have gotten rid of the
Take
car.
a subway. Yeah.
Good for them. That's awesome. But if you have a car, you need automobile insurance. You drive it around, you're probably going to bump it into something or somebody's going to bump into you. I had a hailstorm blow mine up
Yeah.
at the airport. I'm glad I wasn't in the airplane when that happened. But automobile insurance, super important, and you need to have it.
Yep. We were driving through the parking lot the other day, and in the parking lot, this lady just backed into us. So you just never know when it's going to happen. We weren't even on the road.
For real.
Yeah, in the parking lot.
They had insurance?
Yes, they did. Thankfully.
That's good.
So
That's awesome.
They fixed the car, which is nice.
There you go. Perfect. What's the third one?
The next one is disability insurance.
That's right. And we just talked about that in our previous episode,
Yep.
episode number 52.
Mm-hmm.
And especially long-term disability insurance. If someone is relying upon you for your income, you need long-term disability insurance. If you've been working for a while, Social Security, you might be eligible for SSDI, which is the regular insurance program through Social Security. And then your employer many times will offer it, and sometimes your employer will actually just provide it, which is what we do at I Was Broke, Now I'm Not, because it is so cheap. So unless you're skydiving or heavy construction work or military or something like that, long-term disability insurance is super cheap, and you need it. Make sure you get that.
All right. The next one is life insurance.
Life insurance. And so you need life insurance. If someone is relying upon you for income or the work you do, you need life insurance. So we recommend 10 times your annual take-home pay in 20 to 30-year level term life insurance. Now, if you are a stay-at-home spouse, hear how I said that. I did not say they don't work. But if you're a stay-at-home spouse, the work you do is very valuable. They have done an estimate. They call this being a domestic engineer is what they call that.
Yeah.
Did you know they said if you had to hire all that work out, that it would cost an average of like $110,000 a year?
I believe it.
And so if you're a domestic engineer,
Yeah.
you need to get a pay raise. But I recommend you have disability insurance as well. Life insurance as well, because if you died prematurely, somebody's going to have to do that work.
Yeah.
And so we recommend that you start with at least $250,000 for a stay-at-home spouse. Okay? What's the fifth one?
All right. The last one is health insurance.
Health insurance. And so this is, of course, is a huge issue. Health insurance is very costly, but make sure you have at least what's called major medical. It might have a $10,000 deductible or $20,000 deductible, but it prevents you from being on the hook for the $300,000, major thing that happened that you never saw coming.
Oh, yeah.
And so health insurance is super, super important. So let's list the 5 again. List them really quick.
Okay. So home or renter's insurance, automobile insurance, disability insurance, life insurance, and health insurance.
So those are the ones that I believe you need. Okay. Now, the question that they ask is what I don't need. So let's name some popular ones that people get that may be not needed, like cancer insurance. So cancer insurance, think about this. If you have cancer, you're going to be disabled, right?
Right.
So your disability insurance will provide your income. And if you have life insurance and unfortunately you pass away early or prematurely from cancer, your life insurance will cover that. So your cancer insurance, while it might be an added benefit, really you're already covered, so you're almost double insured. And so that type of insurance I would tend to avoid. Whole life insurance is another one. Whole life insurance can be a beneficial thing for many people, but it's after you've fully funded lots of other investment vehicles, and it's so much more expensive. It's about 20 times more expensive than level term life insurance.
Yeah.
And so I really encourage you to kind of avoid that unless you are on rung 9 of the ladder and you've ran out of a lot of other tax efficient ways to invest and have life insurance. And so I just wanted to share that to answer the what I should not have.
Yep.
So let's move on to continue. How do you make decisions of which one to choose? When you go to choose automobile insurance or home insurance or health insurance, they all have 2 components. They have a premium and they have a deductible.
Right.
Okay. So which of those is guaranteed to happen? The premium or the deductible?
The premium.
That's right. So we know the premium is going to happen. So when you're looking at policies, auto insurance policies, health insurance policies, home insurance policies, you need to look at the premium. That's what you're guaranteed to pay annually or monthly or however you choose to pay it. The second cost may happen. That's the claim cost. That's the deductible. And many people who are struggling financially, they're on the lower rungs of the I was broke, now I'm not ladder. They'll choose policies with lower deductibles. Why? Because they have no money in savings.
Yeah.
And what they don't realize is by choosing a lower deductible, they actually are choosing a higher
Premium.
premium. And they're okay with it because they're like, they can't imagine paying $1,000 deductible, so they choose a $250 deductible. What they don't realize is that is a very expensive way to do business.
Should be switched.
So, however, as a person makes progress up the ladder, they have more money in savings. Rung 5 is 3 months worth of expenses and savings. So they can easily accommodate a larger deductible. And it is amazing and astounding, 2 A words, amazing and astounding, how much the premium will drop when you choose to take the increased deductible risk versus the insurance company. So let me give you a practical example to walk through. Let's say you had a home insurance policy, and right now your premium is $100 a month or $1,200 for a year, and it has a $500 deductible. And you went and got a new quote. Listen, this might be you. You're driving right now in your car. Make a note of this. If you increase the deductible to $1,000, in this example, the premium would drop from $100 a month or $1,200 a year to $800 a year. So it drops by $33 a month. So down to $66.66. So think about this. Your guaranteed cost drops $400 a year, and you've only taken on $500 of additional risk. You've increased the deductible from $500 to $1,000.
Yeah.
Does that make sense?
That's awesome.
So think about this. You only have to go 15 months without a claim to win the gamble, to win the bet.
Yeah.
And by the way, every 15 months that you make it, you win the bet again and again and again. And the reason I'm willing to take this bet is I'm not driving my house around. Are you driving your house around?
I am currently not.
So
No.
the chances of you running into something or it running into something is limited.
Yeah.
And so if you have a house that has a claim every 15 months or more, you've got problems. And so you've got a pretty good chance of going 15 months without a claim. I would take that risk every single day because my guaranteed cost drops guaranteed by $400. Now think about this. When we're looking at health insurance, there's a little difference here. Let's say you had 2 policies. And I know this is a lot of numbers when you're driving, so bear with me. If you watch this on YouTube, maybe you can understand a little bit more, and I do recommend you do that when you're comparing, when you get your policies and you can compare them. But let's say you had 2 health insurance policies, and one of them is $500 a month, and it's got a $1,000 deductible, and the other one is $250 a month, so it's half the cost per month. The guaranteed cost drops from $500 to $250, but your deductible goes from $1,000 to $5,000. So you should calculate 2 costs. One cost is, how much does your insurance cost you if you have 0 claims all year long? Not very likely if you have kiddos, right?
Yeah.
And the second cost is, what does it look like if you max out the deductible all the way to the deductible? So in policy number 1, with a $500 a month, $1,000 deductible, the 0 claims cost is $6,000, $500 times 12 months. If you max it out, well, then it's $6,000 guaranteed cost plus that $1,000 deductible, so it's $7,000. That's your max cost out of pocket. Policy 2 has a lower 0 claims cost. It's only $250 a month, so that's $3,000, right? So it's $3,000 less, but maxed out, it's got a $5,000 deductible, so $3,000 guaranteed premium cost plus the $5,000 deductible means you're going to pay $8,000. So which one should you choose? Well, it depends upon your health.
Yeah.
If you're really healthy, it might be a good bet to go with policy number 2 because the premium, the guaranteed cost, is half that of the other policy. However, if you know you will max out the deductible, and listen, healthy person, you might tune me out right now, but there are many people who know they're going to max out their insurance every year. they have a chronic illness, they have diabetes, and they're going to have diabetic claims all through the year. Maybe they have a guaranteed medicine that they have to have that's very expensive. Maybe they've had a heart valve replacement, some sort of issue, and they know they're going to max it out. Well, then in that case, you would want to choose the one that has the lowest maxed out cost. So that'd be the one, yes, it has a higher monthly cost, $500 a month, but the deductible is only $1,000 a year. So they actually lower their cost by $1,000 a year by choosing the first policy. So here's what I would just tell you. Calculate the guaranteed cost and calculate the guaranteed cost plus the maxed out deductible cost. And then look at your personal situation and you'll discover which one is right for you. One thing to point out is I want you to avoid state minimum coverage. That stuff exists with auto insurance a lot. And let me tell you, it really doesn't cover all the needs. So it will have super low, like $25,000 for property damage. Well, let me tell you, most cars cost more than $25,000. And if you go ding up somebody's house, a fence,
It's gonna be a
run
lot
into
more.
a property,
Yeah.
you injure someone, it's a lot more.
Yeah.
Okay? So that brings me to one other type of insurance to consider. It's a sixth one that you may want, and that is an umbrella liability insurance policy. A lot of people carry like $1 million personal liability policy to help protect their own assets should somebody sue them for something crazy that happens at their house. Their kid's riding a four-wheeler at your property. They weren't wearing a helmet, but they get injured. They might sue you, and that would help protect you. It's usually really cheap, a couple $100 for you to be able to get that. And so I encourage you to check out our insurance page at iwasbrokenowimnot.com. There's a great way to get quotes there and find better deals on your insurance. And we have a key financial quote. Share that with them, Megan.
We do. Insurance is the only product that both the seller and the buyer hope is never actually used.
That is the truth, right? The buyer, you, of the insurance, you don't want to use the insurance. And the seller definitely doesn't want you to use it. But when you do have to use it, it sure is wonderful to have it there. You had insurance when you had baby Logan,
Yes, I did think.
and that helped cover a lot of costs, doesn't it?
Yeah, those bills are rolling in.
Yeah, that's right. And, he's going to get all of those preventive care shots,
Oh,
or
yeah.
he's going to have medicine that he has to take, or he's going to have, all these well baby visits at, what are they, 1 month, 2 months, 3 months, then they're every 3 months. And
Oh, yeah, they're a
all
lot.
those things, they're covered with most insurance policies, and it helps you transfer risk to other people, and it helps you do good things with the baby and all that sort of thing. And, you get to have annual checkups, and as we all age, they make us go get different checkups that none of us want. Have at it. That's awesome.
Awesome. All right. So our next episode, we're going to talk about retirement accounts. So couldn't get more exciting. We're going retirement, which I think actually is extremely exciting because
Yeah. So think
you're
about
retiring.
our last episode. It was about disability insurance, disability. And this one has been about like a more holistic thing of insurance. And this next is going to be about more fun stuff like funding dreams. So
Yes.
the insurance ones are protecting your dreams that they could still happen in case something happens.
Right.
This retirement stuff is we get to go on the offense. We don't have to play defense. We're going on offense to go fund those dreams. It's going to
Yep.
be a lot of fun.
So our question is, I have 2 retirement account options at work, a 401k and a Roth 401k. Within them, I have lots of investment options. Can you help me figure out what I should choose?
That's going to be so much fun.
Yep.
I can't wait.
Awesome. So if you like today's episode, please help us get this podcast to others who could benefit. So you could quickly rate our podcast by and leaving us a review as well. These reviews will help make our podcast better for other listeners. And also don't forget, on the last Monday of the month, we're going to be answering your top money questions. So send those in to info@iwbnan.com and it could be featured on our podcast. And also, if you implemented one of our tips, make sure you share your success story with us by emailing it to info@iwbnan.com.
And so we're fired up to be able to serve you guys with the Monday Money Tip podcast. It is Monday. I know that you wait with bated breath and anticipation when we release each episode. And so since it is Monday, or maybe some other day of the week, you have today to take a positive step forward. Go get some new insurance quotes, evaluate the insurance you have, and make sure that you are protected on all those fronts. You will be so glad you did when a claim happens. So that's it for episode 53. We're out. Get fired up.
Thanks so much for listening to this episode of the Monday Money Tip Podcast, presented by I Was Broke, Now I'm Not. If you enjoyed today's episode, please leave a review and subscribe. And for more great content and to stay up to date, visit iwbnin.com. We'll catch you next time.